The only setting to change for the ATR is the duration of time it is based on. Normally, this means a length of 14, which is probably the most common and often seen as a default setting. Looking at the popular daily time frame, this means that the ATR is based on 14 daily intervals represented by 14 candles. Large movements that often significantly change ATR values often take place within a span of 14 candles in most timeframes, including the daily timeframe. So while the duration of 14 candles could be a short time period compared to the longer length of time some other indicators are normally based on, it makes sense for this kind of indicator for the element of volatility which tends to change rapidly. When there are sudden and outstanding price movements, some may choose to reduce the ATR length down to even 3, with the idea to better represent quick shifts in the market that normally expand fluctuations in price to disproportionately large ranges. Though due to the constant change that's always present in the market and the highly dynamic nature of volatility and the ATR, this can be helpful in some instances. But in reality, even changing the length for the ATR setting won't always be a perfect solution. Though to be realistic, ATR doesn't need to be so precise. A general indication of the range price can fluctuate in is good enough. Another common occurrence being demonstrated here is a delay in reflecting rapidly decreasing volatility after a short-term spike. That could be more pronounced in a case like this when ATR is set to a particularly short length. Certainly, the length could be adjusted in an attempt to find some kind of middle ground. Common choices will be 5 and 7. Since that covers around 1 week in the daily time frame and anywhere from 30 minutes to 2 hours depending on which interval is used for an intraday chart, 2 hours and 1 week being common lengths of time for short-term spikes and plunges of volatility on intraday and daily charts respectively. Though in general, leaving ATR at 14 will be perfectly fine. It strikes a good enough balance in a wide range of circumstances. As for increasing the length the ATR is based on, 20 and 22 are common choices, with the idea being to capture that duration of normally 20 to 22 trading days per month. After that, going up to 30 can still be considered short to even medium term on the daily chart, so it can still be a decent length to account for changes in volatility that happen within such shorter durations. Then going from 30 to 40 can become a bit too long of a duration to account for dynamic short-term changes. Though in select cases, especially on intraday charts with small time intervals, setting the ATR length even up to the 50s could still be acceptable. But usually after setting the ATR over the 20s can produce results that lag behind what is actually happening on the chart, even if there are just minor to moderate shifts in volatility, which demonstrates why generally using a shorter duration for the ATR at or below 20 is preferable within the widest range of circumstances. Yes, it's not exactly perfect all the time, but that would be unrealistic, especially in situations like this where a period of relatively low volatility sharply increases just as quickly as it decreases. That is why, as we've seen before, some may choose to shorten the ATR length in such cases, and that can carry over to the intraday timeframes, where rapid changes in volatility often take place during the open and close of the markets. Using the ATR on a longer time frame like a weekly chart along with a shorter ATR setting is possible, especially if the chart is relatively stable, but it's generally not that common. This applies even more so for a longer time interval such as a monthly chart, which is not commonly used, especially during highly volatile periods in the market. So overall, remaining with a daily chart and the usual default ATR setting of 14 will be quite adequate.